Shenar Wood, welcome to Built to Sell Radio.
Hey, thanks for having me, John. Appreciate you inviting me on.
How did you get into the business of burying power lines? That's a sexy business. How did you get into that?
Yeah, so I love the humor in it because there is absolutely nothing sexy about digging ditches, right? I actually learned the trade while I was paying for college. Back in the early 2000s, late 1990s, and 9/11 happened and got out of that and went enlisted in the Army and went and fought. As I was starting to get out, I realized like, hey, the economy's crashing. So is it wise to get out? And got picked up for flight school, did that for another 6 years. And at that point in time, it's like, hey, either I really need to make this a career or I need to get out. And so got out. And then at that point in time, I was like, what am I going to do? Right. And the only thing I knew was this and
this being digging ditches.
Right. Directional boring, horizontal directional boring, and power work. And so I went and bought a drill and I just started the process of, going out and working for contracts. And, here we are 10 years later, 12 years later, actually. And
so I'm like, I know nothing about this. So if I wanted to bury a power line, so I'm looking out my window right now, there's a power line, right? And that's susceptible to wind and snow and crap. And it's probably needs to be buried at some point.
Yeah.
I guess the municipality or the local could decide, hey, we're going to bury the power lines on this street because it's causing problems. And you would bring a giant drill and basically drill a hole in the sidewalk to bury it underneath there. Am I getting that right?
Yeah. So that's exactly what it is. So we would contract out with the IOUs, investor-owned utilities, or the municipality or the co-ops in your area. They will already have pre-identified the areas that trouble power lines, wind, storm, or susceptible to hurricanes in our case here in Florida,
Sure.
or in your case, ice. And so we would come in and we would set up a machine and we would drill the 200 to 300 linear feet, pull in the cable, install it, set the transformer, and get those poles out of the way and the overhead power lines.
Okay, it sounds super dangerous. Like whenever you're dealing with live power, I would have assumed you would have had to be like an electrician with like 20 years experience. Like, isn't that super dangerous?
Yeah, it is extremely dangerous. And so it is a very hard market. So the barriers to entry is very hard because you do need to understand power work. In this case, where we operated a little differently was where there are a lot of buckets. You see a lot of the bucket trucks that come out to do the power lines. We were like, hey, we're going to get ahead of this and install via directional drilling instead of digging up the whole entire yard. We're going to drill and mitigate as much damage mitigate as least damage as possible to your yard. And so as we install it, not only of our linemen have to be good and knowledgeable in power, but they got to understand how the machinery works as well.
But how did you get into the business with no experience? What I'm not squaring is, first of all, you got to buy an expensive drill. I'm sure that was not inexpensive. And then second of all, you have to have the expertise to not kill yourself drilling holes and running power lines. So like, how did you figure out all that piece?
Yeah. So when I started out, I was, 17, 18 years old. My brother had a drill and my summers were spent learning with him. He was actually already drilling. He wasn't necessarily doing power at the time. And as I was going through college, he got into the power work. And as a broke college kid, I was like, man, I really like the money on the construction side. And I don't like being as broke. So I would take a semester off and I would go work at the local IU in Georgia. And they got into this process of like, hey, because it is a heavily populated area, we want you to, actually drill this and install and terminate the power. So went through a lot of classes there, and it was a lot of OJT of learning the power work and as well as directional drilling at the same time.
OJT being on the job training.
Yeah.
So you're getting trained before you put your own shingle out and
yeah.
Got it. That makes sense. How much did the drill cost you?
So right now, so when we first started, the first drill was like 130, 140,000. These are new prices and obviously pre-COVID. And the support equipment. So you're probably at that point in time, again, all brand new in, $250,000 in.
Wow. Where'd you get the money?
So it was personal guarantee. So I was personal guarantor on everything in the company, and you start to feel the debt to income crunch pretty quickly doing this.
Okay, so you personally, so you had some assets outside of your, or maybe not. You just put your name against the.
Yeah. Put the name against it. I mean, I had a little money to put down to help offset, but and that was it. And got the first contract, and it was a subcontract. It was paying net 30, so still had to float net 30. And so this is where the family love comes in. And my brother came in and helped me, and we kind of floated it there for 30 days and until we started seeing the first paychecks roll in.
Did your brother ever say, "Hey, don't start your own business. Come work for me"?
No. So this was the middle brother. And so all three of us knew how to do the directional drilling. But my middle brother who jumped in with me, he's like, man, of all things, are you sure you want to do this? Because we had such a strong history with it. And I was like, well, I don't know anything else that we can go do and somewhat be good at it. Right. And he's like, I guess, and, all the years later, it obviously has paid off. But it was definitely a hard fought question left, 2 weeks. Are you sure? Like, of all things, we want to do this? And I was like, yeah, I think so.
Hey, it's John. Look, if you're building to sell, I want to let you know about a resource you may find helpful. It's called the Value Builder Score, and it will evaluate your company in the same way that acquirers will look at your business. It'll give you a score on the 8 factors that drive the value of your company. You'll also get an estimate of value and things you could do to improve that value over time, whether you want to sell now or in a decade from now. Knowing how the movie ends, I think, puts you in the catbird's seat, gives you all kinds of negotiating leverage. So it's available exclusively through a Value Builder advisor. So talk to your advisor. If you don't have one yet, you can go to valuebuilder.com/score. Let us know what industry you're in, and we will connect you with an advisor who specializes in companies like yours. Just go to valuebuilder.com/score. How'd you win contracts? I'm assuming these things are bidded out.
Yep. So they are bidded out. As you start out, you start out as a subcontractor, right? So you're not necessarily walking in off the street and like, hey, let me go bid on this because of bonding capacity, the insurance, and the sheer workforce needed to compete a lot of these contracts. And so for us, it was like, hey, start as a sub and, make it right there until we, kind of build up a name and reputation so that we can actually go bid on some larger work and really start to grow this out.
So you started subcontracting, low cost provider, we'll do it for you kind of thing.
Right. Yeah. And so what you learn really quickly is it's enough to get by, but the margins are obviously taken at the top right there. Mm-hmm. And so you do that for 2 or 3 years, kind of get your footing underneath you and understand, hey, how does this game play? How does it work? And then finally you're like, hey, I think I can go after some bids here. And so started, incrementally going after bids.
And what's going after bids look like? Are you responding to RFPs? Is it like, what's that look like?
Yep, it's RFPs. And again, one thing I'd mentioned earlier is the barriers to entry is pretty high, right? So a lot of times it's word of mouth, like, hey, this utility or this contract or this municipality has something coming out. It's not very big. And a lot of stuff that you see is where the big guys don't want to play because it's so small. And so a guy like me, like, hey, I would love to have the opportunity to get that and build up the reputation and the relationship from there and continue on. And so that's what it was. A lot is get in. And once you're in, like, hey, we really like your work. We don't want you to go anywhere. And they just, would steadily feed you work.
Yeah. It sounds like it's almost like you're climbing a mountain. Like at the beginning, it's kind of the crappy, low margin stuff. But as you build your reputation, you get the better jobs. And again, it kind of builds on itself as you sort of prove yourself and your reputation.
Right. That's correct. Because the one thing that you picked up and you learned, right, was nothing against the telecom, but the telecom plays a volume game and power plays the safety and quality. And so they value that. So the margins look definitely better on the power or the gas side versus telecom, where it's just like, hey, we just need sheer workforce, manpower, and we're going to hand you, 2-3 million linear feet, and projects are, you hear these crazy numbers, but the margins are so low. So I wasn't set up to really go after that kind of stuff.
What would a typical job for you have been in terms of revenue, gross margin? Like what are we talking about?
Yeah. So from a gross margin, you're looking anywhere from 45 to 50% if you're not the sub, right? Like if you're the prime, you're sitting there at 45, 50. And so it's pretty healthy in that sense. Where it really hits you is on the OpEx side from a safety standpoint, because of the training that's required. That's not really going back into the direct cost of the project. So the insurance, again, the training, that you see in a lot of this, or the material, not necessarily the material that's provided, but the maintenance of, your equipment and trucks and so forth.
Mm-hmm, mm-hmm. And in terms of size, are we talking about hundreds of thousands of dollars in a typical job, tens of thousands, or five?
Yeah, it really depends, right? So you can see municipalities have anything less than 250,000. Whereas, and this takes a longer process. If you get in with the IOU, this very well could be, no less than 2 million up to 150, $200 million. It just depends. Yeah, it can get really big.
I don't know that acronym. IOU. What is that?
Yeah, so investor owned utility. So like a Duke Energy, Southern Company, which owns Georgia Power, Alabama Power, those kind of companies.
Got it. I'd be curious. I mean, this is sort of a family business in a way. I know it wasn't legally, but it was certainly something you grew up with. And I imagine early, as we talked about, your reputation was what built the business. How did you think about ensuring that the quality you personally delivered would uphold as you grew the business and were relying on other people to do the work?
Yeah, so that's a thing that we struggled with, and still struggle with to this day, right? Because the one thing you can't short on is quality, because when your quality goes down, you probably start to inherit safety concerns. And so, unfortunately, and even at the cost of margins, you have to provide that safety, because at the end of the day, it is your job to ensure that those employees make it home every day, because there are, unfortunately, fatalities in this industry where someone's not thinking, doesn't have, lack of better terms, that their head on straight for that day for whatever reason. And so there is a constant push on the safety and training side. So when you go down that path, it does work in the opposite direction of your margins, right? Because this is just something that you have to build into your systems. And to answer going back to your question, I think for me, you realized early on, like, yeah, I can do it, and it's to my standards and what it should look like. But as you begin to extrapolate the business model out, like, how do you do this? And so for me, it was always investing with the guys at every level, whether it was the lowest guy, the middle management, like, hey, this is how we're going to do it. And it's not, we're doing this because I said so. Like, here are the reasons why. And we just really worked through that. And it wasn't from a position or a posture and a part of the table where, like, I know, so do it as I say, or I know better than anybody else. But it's really bringing everybody into the table and like, hey, here's my thoughts. We got to be safe about this. Get the feedback and the buy-in from everybody else, provided that it's within the guidelines and guardrails of our customer, as well as, insurance and so forth and so on.
But how did you stick handle around like, Shenar's a tight ass. He wants us to do it all by the books. Let's just kind of cut a few corners. I mean, I got to go home tonight. I don't want to do everything Shenar tells me to do. Like, did you run into that sort of blowback?
Yeah, you did. But I think when you develop the culture, it kind of takes care of itself, right? Because like you said, I mean, it is mom and pop, right? It is that family feel. But the other thing I put out, I'm like, this is the closest you will ever be to getting a paycheck and owning the business, right? And what I mean by that is like the direct correlation of the work you put in today is reflected in you receiving a paycheck. Not that you're not going to get paid, but in the fact that you decide to cut a corner and it gets caught, or there's a quality control check or whatever, it fails inspection, that's on you. And so if you are cutting that corner, not only will you probably not be working, but you might not be working on this customer systems, and because they have the ability to say, hey, we don't trust this guy. We got to get him off of here.
Was it a union shop, your company?
No, non-union.
Okay. And walk me through the way you think about or thought about unions as, because I'm assuming a lot of your competitors would have been unionized. Is that right?
That is correct. So our parent company today is union, and we are non-union. For me, growing up in the South, there are union shops here. They're not as strong as you would see up in the North or Northeast or Midwest or out West. So for me, it was never a thought of like, hey, that we're going to have a union type business. And it's hard for union shops to come in, not to say that they're not any here, but it's hard for them to come in and compete at prices versus non-union. And there's pros and cons to the union side or non-union. So for me, it was never an idea that, hey, we're going to entertain a union or non-union. I wouldn't even know. I mean, I knew where the IBEW was in Atlanta. It sits right off the side of the interstate. But outside of that, I had zero interaction with union shops coming up in the industry. So it never even crossed my mind.
So it didn't, I just want to be clear. So it wasn't a threat that you perceived that, oh gosh, if I don't pay my people well or treat them well or adhere to safety standards, I'm going to get a union in here.
Yeah. So, I mean, I think that kind of goes back to my point where it's just not as strong, right? And it's not to say that our pricing non-union is not as competitive. I would say hourly, not benefits and all the other stuff that comes on the union side, but just from an hourly perspective, I would say the non-union shops in the Southeast in this particular line of work is stronger, if not stronger than the union shops pay wise, not benefits and all the other stuff that they receive, but from a straight up dollar for dollar hour wise, it's, I would say, very comparable.
It sounds too good to be true in a way, because I mean, you started in 2015, as I understand it, and sold in 2025, 10-year run. You know, no huge capital investment, although you took out a personal loan. But you had a great exit. We'll talk about it in a second. Was it that easy? Was there a fork in the road or a challenge that you thought might bring the company down? Like, what was the biggest obstacle you faced in growing this company?
Oh, there's so many forks in the road, right? As many entrepreneurs experience, there's, when I was subcontracting, it was like, hey, I don't know how much longer I can keep on doing this without I can't afford to grow this out with just subcontracts, right? There's no margin in it, because prior to becoming a prime or a primary contractor, it's not that 40 or 50% gross profit, right? Like, you're probably at best 30, but probably realistically 15 to 25. And as we all know, that's just gross. That's not your net. So you're doing good to break even at that point in time, right? And so,
becoming a prime was an inflection point for you. That was an important step in the rung, for sure.
That is correct. So that which required me to go get my GC license and all that kind of stuff, right? So I jumped through all the hoops to do that. So that was a point of inflection. Another was we had grown up to 50 employees at one point. And it was like, hey, where's all the work at? And so what I realized is like, hey, I'm going to have to leave the area. So at this point in time, I was in Charlotte, North Carolina, and we were operating pretty heavily in that area. But to continue to grow this out, I have to leave Charlotte, right? And you start to, because you're so debt leveraged and because you're the personal guarantor of everything, to go out after other bids, you have to go through sureties to get the bonding, right? And so bonding companies don't want to see you debt leveraged. And so you start to hit this glass ceiling, right? Of, hey, I've grown all I can on my own, like just signing my name on everything, right? But to go out and get other bids or to grow into other markets, surety or bonding companies will not look at me because I have so much debt. And so
interesting. I don't know anything about that world. So a bonding company will explain that to me. What does that have to do with your personal debt? My ignorance.
No. So what happens is, let's say the local municipality puts out an RFP or an RFQ, and it says, hey, this is going to be streetlight project and it's $500,000, and I'm just using round numbers here.
Sure.
But we want a 5% performance bond or a construction bond tied to this, right? Meaning that at all costs, this work will get completed by the contractor. In the event I don't, the bonding company steps in and will pick up the slack on all this, or bring in another contractor to finish out the workload. So what happens then, you go to a market, the surety markets, and they look at your financials and they say, hey, because you carry a lot of debt, you don't look that healthy to us to make a bet on you. And so that's another reason that you start to see like, hey, I tell a lot of people from the PE side or from VC side, like there's a glass ceiling, like the ideal that, hey, I'm going to grow this business, to $100 million, and I'm going to compete with this. Like you're competing against, not against just that business, but private equity money or VC type money at those levels. Right. And for me, like I didn't have the capital runway to outrun that and bust through that ceiling, like because I carried the debt on all the equipment and it is a capital intensive industry. You're just not that attractive from a bonding capacity. So that limits your ability to continue to keep growing.
That's really interesting. So roughly you're 50 employees, roughly where are you on revenue at this point?
So at 50, we were right at top line, 5 million.
Got it. So you're 5 million, you're 50 employees. And what would your debt have been? Like, what have you personally signed for at this point?
Gosh, I would say at least at that point in time, 2.5 to 3 million.
Wow.
Yeah.
Huh.
So think about this. And at this point in time, we're starting to get through COVID and whatnot. So that same drill that I was telling you was at 140. Sometimes they were 180, depending on the size, right? Mm-hmm. That same drill today is $330,000.
Wow.
Yeah. So as you can see, these prices keep growing. The other side of this is when you sign these long-term contracts, like with the Duke Energies or the IOUs of the world, right? You're locked in for 3 years, and it's typically a cost of living allowance raise, right? Where it's hey, we'll increase by between 2 and 4%. So that's great. But that doesn't keep up with the cost of what the material, or the equipment cost is on the trucks or the machinery. And so you start to run against that as well.
Yeah. So you're growing this business nicely over a 10-year run, 5 million revenue, but it's not without its challenges. In particular, debt is up to 3 million, and you personally signed for that. And then each of these jobs is looking for more kind of, you call these bonds, but effectively they're looking at your overall debt coverage and thinking, this is a lot of debt this guy's taking on. Wait, what's your personal situation, if you don't mind me asking? Do you have a spouse, kids, that kind of stuff at this point in time?
Yeah, so wife, and at that time it was wife and one kid that was, oh gosh, I think she was probably 10 or 11, and then we had a newborn as well.
And so how... I always think this is hilarious. Like, how are you kind of sharing this with your spouse about like the level of debt? Like, are you, what's the, like what level of exposure or disclosure have you given on this debt level?
Yeah, no, I have to tell you, I probably married up right in this situation. I have an angel for a wife because she knew every bit of it. I told her, I was like, hey, I got it. I mean, she saw me signing for every bit of this. Matter of fact, so she has her master's in HR. And so she was my director of HR and
that's good.
Bringing all the benefits and adding everything, making sure we were compliant in that sense. So she saw it, but she never really... It didn't bother her as much as it did me, right? Like I knew that I had to wake up every day to ensure that, hey, do we have the work in front of us, not only to pay our bills, but to pay our guys as well. Yeah. And so there's that constant pressure to keep on growing.
And was there a secondhand market for those drills? Like if you'd gotten into real trouble, could you have sold one on the...
Yeah, you could. I mean, it's, and there was equity in those drills, right? But I tell a lot of people, you don't get into this business to like, I've got, 20 drills and 40 trucks or whatever the numbers, right? Like the idea to think that you have this much equipment is probably the wrong way to look at this. for this type of business, it's what kind of contracts you have. Like the value of your business outside of EBITDA and all this other stuff is like, what are the value of your contracts? Because your contracts is what will keep you going, as opposed to, oh, I've got 40 trucks. I mean, the truck will make you money, yes, but it doesn't necessarily mean that, it's waking up to make you money if you don't have a job to go to, kind of thing.
Yeah. And so I'd be curious to know, like at this stage, you're 5 million in revenue, 50 employees, profitable, like profit margin at this point, like ballpark?
Yeah. Profit margin. I mean, we're still probably in the, just because of the debt load, and this is the profit, we're still gross. We're at 40, but I would say that the net, we are dipping down into the low teens at this point in time.
Got it. Okay, but still clearing a fair chunk of change. Have you got any sense of what the company's worth at this stage of the game?
So this was another inflection point. So when I got out of the military, I had the degree. It was in criminal justice, which has nothing to do with, I just wanted the degree so I could go to flight school. The one thing the military teaches you is leadership, right? What I realized during that point in time was like, I know budgets from the military. We had a massive amount of budgets to work with. But what I didn't understand was P&Ls and balance sheets. And so I went back and got my MBA at night, just to kind of put another tool in the tool belt. What you start to realize is, and I'm sorry, go back to your question here.
Yeah. Do you have any sense of what the company's worth? Your 5 million revenue?
Yeah.
Like, is it a multiple of EBITDA or a multiple of revenue? Like, how are you thinking about it?
So this was it, right? So I go through the MBA. I meet one of my very best friends, and he's a senior over at International Paper, but he's a finance guy. And I was like, hey, can you look at my financials and tell me what I'm worth? Or what do you think the company is? Is it cash flow based, analysis? What are we looking at? And so he looks at it and he's like, Shenar, I can't make heads or tails of your books. And I was like, what do you mean? I was like, I have my books done. And he was like, Shenar, I couldn't tell you if you're profitable or not in this sense. And so what I had learned at this point in time, and so this is great for all the listeners out there, just because you're filing taxes, maybe your books are not the way, it's not telling the story that it should for private equity or a sell, right? So it cost me $180,000 to go back, recreate all my financials. For
180 grand?
Yeah, because they charged
me. Who did you hire?
Yeah, so they had to go back every month for the past 36 months and recreate all my financials.
Okay.
So lesson learned, don't just get a tax accountant. Ensure that your books are being properly, that there's gap accounting financials taking place. Below the line for EBITDA, whatever the strategy is for your company, ensure that those books are very tight.
Okay. So your buddy's like, wow, I can't figure this out. You hire this company, but you didn't answer my question, which is like, are you starting to think about what this thing might be worth?
So finally get through this. This took like a 12-month process to get this right. We get in there and he's like, okay, I can finally see what, I can put this in and see where we're coming out. And at that point in time, we're thinking like, hey, this is probably, between a $5 and $10 million business. Like we could actually show it from an EBITDA standpoint, from a cash flow standpoint. Like, hey, there's value here, and the books are right. And so we knew we were between that at that point in time, that 5 to 10.
And what multiple of EBITDA is that inferring?
Yeah. So for us, in our industry at that level, you're at 4 to 6.
4 to 6 times.
Yeah. Right. So you're there. The things that really, there's multitude of things that can drive that number up. Obviously EBITDA, higher EBITDA. But is there software in place? Is there real estate involved? There's, again, a multitude of things that can drive that multiple up.
Okay. But you're thinking this is I've got some debt, but this is a significant asset that should be worth something one day.
That's correct. That is correct.
Okay, so where does it go from there? Like, what was there some sort of trigger that made you want to sell, or like what happened?
Yeah, so it was that glass ceiling, right, that we were talking about earlier. It was like, hey, I know the model works. It's been validated. Here is 10 years worth of proof that this does work. but I can't get past the bonding, right? Like it's hard for me to walk into a Wells Fargo, a Bank of America, and like, hey, I'd really like to get, and at this point in time, $1 million or $2 million loan is not going to do much for me, right? Like I needed access to some more capital. But again, you're not sexy because you're digging ditches for a living, essentially, right? And so you could look at ABL types of stuff, asset-based lending,
Okay.
or alternative financing. But again, to really grow this, I needed 5 to 10 million. And so not really knowing the financial markets and where to go to raise this kind of capital, I was like, and it's worth something. Like maybe I should talk to a broker to put it up for sale and not necessarily walk away, obviously continue to grow it out. And so I'd kind of wrestled with the private equity thing, and I went with a broker, and 4 or 5 months later, we started taking interviews about the company and went from there.
What was the process? Tell me about the process of working with a broker. Like, what did they do in that 4 or 5 month period before you started to talk to potential acquirers? Like, what did they do to get you ready?
Yeah, so this was it was weird in the sense for me because he was on the buyer side, not necessarily the seller. So for me, there was no cost up front, but he did put the flyer together for the company and floated it around to a lot of the PE firms in New York and Boston and out west. And so I'm not really sure what the flyer looked like. But he knew that my financials were there. We'd done several one-off interviews, and he was like, "Hey, there's not much more. I really need to prep you for this. I'll put the flyers out. I'll be on the call if you need me. But outside of that, just talk to him as if, it's not a salesy thing of how great you are. Like everybody understands there's hiccups in businesses, and just talk through whatever it is you want to, what you have on paper there."
So did you get some interest?
Yeah. So we had, I think it was like 4 or 5 that was looking at us. Several that probably thought that they were just kind of kicking tires to kind of see, what you're about. But there was 2 that was really pushing pretty hard, a group out of Houston, and then eventually our parent company that was at the table.
And what were those conversations like? Like, how did you qualitatively distinguish between tire kickers and no, these guys are actually serious?
Yeah. So it was really on the follow-up, right? Like a lot of the preliminary conversations were very platonic at first. So like, hey, just trying to understand the makeup of me or the owner at that point in time. And like, hey, is this guy, buying bass boats and Harleys on the weekend? Or is this guy like, hey, is he really trying to grow this business out? Right. And so they're really trying to understand who you are as an individual and what drives you as an owner and what this company is all about. And
what kind of questions might they ask you to ascertain that, to get at that?
Yeah. So it's as simple as like, hey, what do you do in your spare time? It's and like most entrepreneurs, like, well, this is business, like because it's your baby, right? So they're like, obviously, what's your background? How did you start the company? And it's a lot of the questions we're talking about today. So it's they're easy conversations, right? It's when you start to get into the finance, but that's not on the very first conversation, right? Like you start to get into the NDAs. When you see the NDA come over, that's when you start to kind of feel like, hey. And even then, there could be tire kickers, but it starts to kind of weed out a little bit as you start to sign the NDAs, because a lot of people don't want to put the energy into it to like, hey, do we really want to do a deep dive into this or not?
Got it. And they have some legal exposure to signing a non-disclosure agreement as well, both sides, obviously. Right. So, but you took that as a sign that, hey, these guys are legitimate here. They look like they're kind of want to dig in. And so how many companies, you mentioned 2 that did an NDA and were kind of digging into your books a little bit? Yeah,
that's correct. So we go through that. And so what was interesting about the NDA, the finance part of this is, the books are the same for both companies. And it's really how at that point in time, like, hey, is this legit? For us, we had audits because of trying to go through bonding and so forth. So there was not anything that was out of the ordinary on our books for that sense. But it was like, hey, what are the synergies? How can we grow this out? So at this point, they're starting to figure out, hey, if we sink 8 million, 10 million, 20 million into this company, can I get a 5x return on this? Like, what does that look like for them on their side? So they're starting to visualize what it's going to take to grow you out, and what it does for their overall business.
Did they share that number of 5x with you? That was the bogey that they wanted to?
They didn't share that, but you would have to assume, like, if you're going to invest in a company, that you'd at least want a 3x return to 6x, because at the end of the day, the PE firms represent money from a large group or a small group of people, and so the portfolio manager, it's his job to ensure that they're getting the returns on their investment for that round of funding that they have out there.
What happens next? Do you get offers from both, or?
Yep. So we received offers from both, and ended up with the parent company now, Thayer, out of Columbus, Ohio. The other group was more directional drilling focused, and not necessarily on the power. And we kind of fit the Thayer, what their model is, because they are heavily focused in overhead bucket work power lines, but they don't have the underground component. And so we provided not only the underground component, but the non-union side in the Southeast, that a market that they were trying to break into. And so the other company, like I said, was more of a larger directional drilling focused type company. And they didn't really care one way or the other if they did power or gas or water, which there was nothing wrong with that. It was just they solely focused on the directional drilling aspect.
Yeah, and I'm assuming the Thayer guys were willing to pay up for the synergies. Like, you were a good fit for them.
That's correct. And again, it gave them entry into a market that they didn't have into the Southeast, and as a non-union side. And so that was a piece that they had originally tried to break into, but struggled because of the union pricing to come into the Southeast and compete or be competitive with other operating partners down here.
So you've got this offer, which is a multiple of EBITDA. How does the debt get treated in the offer? Because you still got this debt, right?
Right.
How does that impact the offer? Like, just explain that.
So it doesn't, right? It affects you in the sense of the liquidity event that occurs, in that you will pay it all off. So it's still my debt. So in this event, there's a liquidity event up front, which was more than enough to cover all of our debt. So I pay off all the debt. Whatever's left over, obviously, it comes to me at that point in time.
Okay, so that's interesting. So I'm just going to throw out round numbers, and these aren't your numbers. And I know we talked offline that you can't share them, and I totally appreciate that. But so I'll just make some numbers up. So let's say you had 2 million of EBITDA, and you got 5 times, that's 10 million. But you got 3 million, so you'd net 7. Is that the kind of math that we're like?
Yep.
Again, your numbers excluded, but just hypothetically, that would be what it would look like. Okay, right. So you pass the business over to the acquirer debt-free, effectively.
That is correct. And so for us, it's a stock deal, not an asset in the sense of, yes, they own all the assets, but as a stock deal, they own 100% of all the stock at that time. So naming rights, everything, they own it all at that point in time.
Yeah. And, when I've spoken to other business owners, sometimes they're surprised that it's not like a multiple of EBITDA plus the assets. Like, hey, and I bought these trucks, or I've got these drills, or whatever. Like, was that a surprise to you to learn that you're not going to get value for the actual drills themselves?
I think for me, I didn't value the assets anyway, right? Like I knew that if it was to ever go to auction, we're talking, people say pennies on the dollar, but realistically, maybe 50 cents on the dollar, like whatever the auction prices are. So I never really, like, yes, I carried it as a debt, but I never really viewed it as like, hey, these are mine, kind of thing. I just always rolled it in. Like it was not even a thought that, hey, I want this plus the cost of the assets.
Got it. And how do they deal with like the terms. I think there's an old expression in M&A terms, which is, I think it goes something like, you set the price, I'll set the terms. In other words, like I'll give you whatever you want for your business, but I'm gonna set the terms. So how do they structure the terms for you?
So this is where it pays to have a good lawyer, right? And I will name drop David Werble with TCF Law out of Boston. This guy is phenomenal. So he helped me with this, right? Like this is my first rodeo into any of this world, right? I have no idea what it looks like. And he come in and is like, hey, Shenar, this is where we want to be at. So literally when we went through our calculations and our numbers, we were within a couple 100,000 of each other, right? So what you learn is the EBITDA multiple is going to be what it is. Like there's not a lot of negotiation to negotiate as far as the multiple. Well, you can negotiate the multiple, but it's kind of hard. But whatever that price is, that's what it is. Maybe there's, again, a couple 100,000, but you're not getting, if you're at, again, I'll make up a number. If you're at 20 million, you're not getting 25. Like it's not happening. Maybe 21, maybe 20.5, but you're not getting 25.
Yeah. And so this is specifically your industry and some of the dynamics in your world. It trades in a very tight band. It sounds like those businesses are fairly well, like it's tight band.
That is correct. So for me, there was also an earnout involved, right? So this is where I negotiated the hardest on, because what I didn't want was the earnout to be a pie in the sky kind of thing. Mm-hmm. I knew that from an EBITDA and a growth standpoint, I was going to get debt laden to continue to keep growing. It was going to affect the balance sheet as we continue to grow this out, right? And so for me, I negotiated more on the EBITDA, on the earnout, and the key markers around that. And so I think it's those areas, and this is where I'm very appreciative of counsel to really like, hey, let's focus here. The number is whatever the number is, but you focus on the earnout piece and how it's paid out, defining whatever gap is, defining what you're going to put into what's going to get pushed down to me, right? Like, hey, to continue to grow out, maybe you need $5 million more of equipment. Hey, is that going to get pushed down to me, or is that going to stay at the parent company and you guys just have it on your books? So understanding those kind of concepts of how that debt's going to get pushed down to you and your earnout, specifically if there's an EBITDA number tied to your earnout.
Such good advice for our listeners, because for most of our listeners, I think there will be some measure of earnout for sure. One is to make sure you think about any capital equipment, like big chunky expenses, like who's going to cover those and how that's going to be reflected on your books. That's one. You mentioned this lawyer in Boston. Were there two or three other things that he kind of coached you around in terms of making sure that the earnout was achievable?
Yeah, I mean, that's the other piece of it, right? That we really talked through was, there's also revenue incentives, right? To continue to grow, right? In the sense, because what you don't want to do is to take contracts, just say, well, like, hey, I generated revenue and it's not profitable type jobs that you're taking. You're just doing it. So you want to be a good steward of, the parent company as well and what they're putting forth. And so there was just language around, in the event any of these deals were to go sideways, and it's kind of hard to recall a lot of the legal language that they put in there, but it's really protecting yourself in the event that this goes sideways, right? That's where the legal advice or the legal counsel comes in.
When you say this goes sideways, what are you referring to? Yeah,
so let's pretend that that you had stuff pushed down to you. You're like, hey, well, that wasn't discussed, but we're gonna push down. Pretend we're going to push down back office support to you at your level. And you're like, well, I didn't ask for that. And it wasn't really called out in the contract. And now they're going to push, 4 or 5 different finance departments or accounting departments, more HR, more safety down on you. And you're like, hey, when we were going through this, I didn't anticipate to carry, again, I'm making up a number, $1 million worth of revenue or expenses and salaries that got pushed down to me. I thought, you guys had this, so this should stay at your level, not necessarily get pushed down to me at my level. So this is where the legal counsel is really good to ensure that, like, hey, if you're saying you're gonna, you have all this support, ensure financially from an accounting standpoint, that it still stays at that parent company level and not pushed down to the new company level.
Yeah, yeah, and I'm not sure if you're able to share, but kind of roughly what proportion of your proceeds were at risk in an earnout? Was it like a big chunk?
Yeah, I wouldn't say a big chunk, but just guessing here, 30%.
Okay, yeah,
Yeah, so
significant
it wasn't
material. But
it was, yeah, there was enough skin in the game. Like, and so I'm 46. Like when this happened, I was 44. I'm still fairly young. Like I still want to continue to keep on and grow this out and see what we can actually do with that. So for me, that still fit the personality of like, not necessarily, hey, this is my baby. But it was like, hey, this thing can really grow out to something pretty big. I just need the help and support to grow this out.
Yeah, yeah. And just so I'm clear, and really for the benefit of people who maybe haven't gone through one of these before, we talked about hypothetical, a business in this industry might be worth 4 or 6 times, something in that sort of broad range. Would that be before the earnout, or would the 4 to 6 include the at-risk component in the earnout?
Yeah, so it's the at risk. It's that latter part. So it's an all inclusive type.
Yeah,
that you're looking at.
Yeah, that makes good sense. And interesting. Okay, so what was diligence like?
So, everybody wants this thing. Like when you see the letter of intent come over, you're like, oh, this is done. It's over with, right? Reality is there's another 3 to 4 months behind this. And in some cases, the larger the deal, the more due diligence, right? So for me, just to give you an idea, start to finish was May, and then we closed in December the 1st. So 7 months. Yeah. So just because you're talking to the guys and just because you get the letter of intent, this is where the real due diligence comes in, because it's really still going back into your financials, right? Like, yeah, we've discussed it and we like it. That's where the letter of intent, but now we're going to actually dig into this and see what it looks like, right? And then there's the legality part. Like, hey, we're checking for, are there lawsuits out there? Or, what other things out there? What does the debt actually look like? And you're really checking the references on the debt. And then their legal team is going through all your contracts with your customers. Like, hey, is there any kind of hiccup that would, when we purchase this company, do we still have a contract with the customer, or do we stand to lose it because the name changes or it doesn't change? What does that look like from the legal part on their side? And so that could take, between their accounting firm and their attorneys looking at everything, easily there's another 2 months there. And then, by the way, you still have to negotiate at the end of this, right? So there's that banter and back and forth to kind of get this locked up and settled down as well.
Was there a lot of retrading?
I'm sorry, retraining?
Retrading, meaning, hey, we said we were going to pay X, and now we're only willing to pay 80% of X.
No, we didn't really go back and forth on that. It was really around the earnout piece and ensuring that, again, this is not a pie in the sky. And so there was an EBITDA number and a revenue number. I was always good with the revenue numbers, but the EBITDA, knowing that, hey, because there's going to be such a large CapEx involved to continue to grow, it's going to affect EBITDA. And so we really need to focus on this EBITDA number.
Got it. Yeah, that makes sense. When I've spoken to other entrepreneurs about diligence, I think there's kind of 2 camps that people land on. One is the acquirer was just doing their diligence to ensure that the business would continue as stated in the letter of intent or in the offer listing, et cetera. Checking contracts, checking durability of revenue, et cetera. Legit. And then there's a minority of instances where it's clear that the diligence is really just an effort to retrade. Like it's really just trying to identify ways that they can kind of grind you down. It sounds like yours was more the former than the latter.
Yeah. So it was definitely that. I would say, as far as negotiations with my group and what we went through, was I probably couldn't have a better first experience to go through. It was really up and up. And even to this point now, like we all hear horror stories dealing with private equity. I don't know if I'm one of the few or far ones out there, but I will tell you, for me, it's been absolutely wonderful. Been nothing but straight up and honest with me. I mean, there was things that we would have to go back and kind of look at, but it was nothing really ever got sideways as far as retrading on the multiples. Like, hey, well, we thought this, but now we're seeing this. Like, we never really got into any of that whatsoever.
Well, good for you. That's amazing. I'd love to do a quick lightning round of questions with you. Just a couple word phrases, answers would be great. You up for that? Yeah,
absolutely.
Okay. Emotional high of selling your company.
Emotional high selling a company. There was, it was great. There was more tears of joy.
Describe it. What was the emotional high? Can you remember a moment?
Yeah. So we closed, believe it or not, like I remember to this day, like 4:30, 4:45, when the wires came in on a Friday. Again, I think it was December the 1st. So we're coming into the Christmas holidays, and just the thought and the idea that we have built something that someone actually wanted and you sold it, right? Like the feeling, it just validated the last 10 years of your life. And so I still get kind of choked up thinking about it, because it just validated all the pain and suffering for those 10 years, that like, hey, yeah, someone else sees the value in this as well.
And I imagine it must have been even more rewarding to share that with your spouse, because your wife knew everything, right down to the debt you'd personally burdened for 10 years.
Right. So, I mean, again, we both just kind of like, again, I remember it's like 4:30, 4:45 on that Friday. And we're like, it's over with, like it's done. And so just that relief, knowing that all the debts, I'm not carrying the debt anymore. And that it was over with. A new journey began after that, right? Because now you got to go execute on what you promised. But outside of that, like the overall debt of carrying, like, I don't have to worry about making payroll. Like I'm covered in the littlest of things. I'm covered down with all of that.
That's got to feel great. What about the emotional low?
Selling or before selling?
The whole experience. So from the kind of moment you started the sale process, you engaged a broker, they start to do the flyer, et cetera. From that point to today, what has been the emotional low?
The idea that at some point, it's more thinking ahead that I won't, I may be here, I may not be here, right? But knowing that there is an exit for me at some point that I'll have to exit, right? As far as continued growth for myself, right? And knowing that, and it's the little thing of being able to see a truck out with our decal on it and say, hey, I started that, but I'm no longer a part of that. And I think that's the realization. You're like, man, I'm no longer a part of this.
Yeah. Forever the founder, but someone else is going to own it. Yeah.
And you have to move on, right? Like there's no way you're going to grow at that point in time if you don't really separate yourself from that.
Did they keep the name?
Yep, kept the name. We just changed more of a legal structure from an S corp to an LLC.
Yeah. Do you think they'll keep it in the future?
Yeah, I think so. Right. It's growing. It's doing really well. It was the thing that I always said we needed, right? Which was cash, and you needed access to it. Mm-hmm. They have it, and we have been able to grow, quite literally 100% year over year since we've had it.
Unbelievable. Congratulations. That's amazing. One thing you wished you had known before you started to sell your company, like one thing you wish you'd known about the process of selling your business?
That I started it earlier, the process.
You wished you had started earlier?
Yeah. Because the idea, there was no value in for me to keep the company from years 6 through 10. Probably the value created may have netted $250,000, $300,000, maybe. And so as you think through these processes, right, look at your company today, because if you don't see the ability to gain an extra 4 or 5, 10 million for the next ever how many years with contracts, in our case, contracts, then go ahead and start the process today. Like, don't wait for another 6 to 10 years of just grueling hardship when it's only going to net you another 250, 300,000 in valuation.
And explain that, because you had reached a point where the debt ceiling was, you were on this sort of like plateau where you couldn't punch beyond it.
Right.
And you sat there for a couple of years.
That's right. So you get into that plateau. And so what I mean by that is, if the revenue and your EBITDA is not going to grow substantially, right? Like if you're only growing EBITDA by 50,000 or 100,000, right? Like again, we'll call it 6x at 100,000. So you're only going to gain 600,000, but you set on the company for another 5 years. Was it worth you to set on the company for an additional 600,000 for 5 years? I would argue, in my case, it's not worth it. Like,
right.
Go ahead and get out, start a new company, whatever the scenario is. But why would you wait for another 4 to 5 years for additional? If you say, hey, I can I can gain another $1 million in EBITDA or 2 million in EBITDA or whatever that number is, then you have to really think like, hey, it's probably worth it. But if you can't really draw that line in the sand or you can't see that in the future as you forecast out, it's not worth it at that point. To me, it's not worth it in that point in time.
Yeah. Were there resources that you could point our listeners to that you found helpful in learning about the process of selling your business? Were there, TED Talks or YouTube personalities that you turn to for help?
There's not a specific TED Talk that I can recall, but I tell you, for me, listening to Jamie Dimon and having a balance sheet fortress is probably one of the biggest things that I learned from this, right? And so, ensuring that you're not so debt ridden as you start to grow out this, right? Especially if you don't have the private equity and you're doing this out of your own pocket, and specifically if you're having to deal with bonds, the surety part of this, right? Like kept me from growing, but at the same time, I could have grown it out slowly, but it would have took me another 20 years or 30 years at that pace to really just chip away at it. And I was like, do I really want to do this for the next 20 years? Maybe I do, maybe I don't, but not at this pace, right? Like I really want the growth.
That's helpful. Jamie Dimon, of course, the CEO and chairman of JP Morgan Chase.
That's correct.
Is that a book that he wrote? I've never heard that before. Something Fortress?
Yeah, I don't know if it was a book he had out. It might have been one of his podcasts or talks that he was on.
Okay.
And then I just started digging into it, and I was like, he's right, because even in the tough times, if your balance sheet is good, you're going to make it through the tough times. And matter of fact, you probably position yourself to come through that tail end of that bad times to really accelerate your growth. And so knowing that now, I'm like, that's absolutely right. And so it's really like trying to keep, your debt to income or debt to revenue a 3-to-1 ratio. Like you want it below that. Anything above that, then you don't look that stable as far as a profitable company that someone wants to back you in.
Yeah, makes sense. Last question: what trophy did you buy yourself to commemorate the win?
Gosh. I feel vanity moment.
Don't let me down here, Shenar.
So I love watches. So I bought a couple watches.
What'd you buy?
So I went and bought the Submariner, the Rolex Submariner.
You say obviously, like everybody's on.
Yeah, obviously,
everybody
right?
buys one.
Yeah,
The Submariner Rolex, which is the classic.
It is the classic, right?
I'm a baller.
Yeah.
Rolex. Yeah. Okay.
It's a great watch. It is a phenomenal watch. And then
it's the precision timing piece, right? It keeps a great timing.
It's timing. It's what the Navy divers use forever and a day. And so I got that, and then I bought a Moser Streamliner.
Okay, I'm not familiar with that brand. Moser.
Yeah. So they're a micro brand out of Switzerland. Very fine-tuned. There's Moserland in New York City. It's a small niche shop, but cool. Really nice, beautiful watches.
And what was it about the watches that is meaningful to you?
Yeah, it marks the time, right? Like, and I'm not talking the actual time of the day, but it just marks like, hey, at this point in time, I know exactly where I was at when this happened, and it's something I can pass on to the kids. But it just really marks that spot in time in my life of where I was at, what was happening. And so, even when we started doing really well, like my first big nice watch was the Tag Heuer. Lovely watch, still love it to this day. But I knew that's when, hey, I think we have something here, right? So all my watches kind of mark at time and like where we're at with everything.
That's awesome. That's awesome. I'm a big believer in having something physical, a trophy to just put your hands on and remind yourself of the achievement, which is a substantial one. I'm really grateful for you sharing your story. I think it'll resonate a lot with a lot of our listeners. If people wanted to reach out and say hi, what's the best place for them to do that?
Yeah, so I'm not pushing a book or any kind of guru lectures or anything like that, but I do post a lot of content on LinkedIn. So it's Shenar just dash Wood, singular, no S.
Awesome. And we'll put Shenar's LinkedIn profile in the show notes at builttosell.com. Shenar, thanks. This was a super fun interview for me. Thank you.
Yeah, thank you as well, John.